Is the stock market headed for a dot-com level crash? This week on the fastest 4 minutes in finance, comparing the AI boom to the dot-com boom, where it's similar, where it's different, and where we could be headed. Hello and thanks for joining us this week. I'm Scott Inman. Well, it is a popular comparison, and in most cases, the comparison is used to predict the bursting of our so-called AI bubble. So the argument is that we are getting ahead of ourselves when it comes to the technology that will eventually change the world. And the last time this happened was with the internet back in the 1990s. So let's take a look, with the help of LPL Research, at the comparison. Here's a chart overlaying the performance of the tech-heavy NASDAQ 100 index during the 1990s, that's the blue line, and now that's the orange line. So the starting point for the dot-com era is from the launch of the first internet browser in 1994. The starting point for the AI boom is from the launch of ChatGPT in 2022. So you can see from a timeline standpoint alone, we are early in the build-out process for artificial intelligence compared to the build-out of the internet. Now, that's not to say that from here it might be faster, slower, or even the same, but strictly from a performance perspective, the current tech-driven bull market may have a long way to go. The NASDAQ 100 is up more than 140% since ChatGPT was launched. The same index skyrocketed over 1,090% from 1994 to 2000. But are the two tech booms the same? Not really. LPL Chief Equity Strategist Jeff Buchbinder points out 4 key differences. First, stronger leadership. The leaders of the AI build-out are funding it mostly with internal cash flow, not speculative capital raising. Their business models are more diversified than the website-oriented business models of the 1990s, and their balance sheets are stronger. Second, grounded valuations. In March of 2000, the technology sector peaked at a valuation 58 times consensus forward earnings compared to 25 today. Third, more rational IPOs. The technology companies going public are much larger today, with proven business models and sizable revenue streams. And finally, AI is early in its cycle. We are still in the build-out phase. AI adoption has barely begun. During the dot-com era, right before the crash, there were lots of consumer websites that could never be sufficiently monetized, even after the infrastructure was in place. We don't know who will ultimately be the AI winners and losers when it comes to adoption, but the strong balance sheets of the infrastructure builders are a good place to start. Bottom line, don't let the fear-mongering get to you. There's no reason to believe we are on the verge of a market crash. Could we get over our skis a little? Sure. There will be volatility as investors evaluate the companies changing our world. But as Buchbinder writes, we think this bull market still has a way to go and expect the technology sector to lead. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.